Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video we're talking about what is next for UK interest rates. Now I have about £3 million worth of property, great. I also have about £2 million worth of debt, not so great. So on that £2 million, interest rates really do matter to me, and it's very pertinent to me at the moment because at the end of January my very last 5-year fix back from 2020 is coming to an end, so my entire portfolio will be on the new higher interest rates, and that's quite a big mortgage. That's about a £350,000 mortgage on a 6-bedroom HMO in Oxford. So for me, interest rates really do matter. Moving forward, my outgoings on mortgages have more than doubled. So we need to really address this. We need to understand what's likely to happen. We need to understand some of the factors behind it. And if you like this sort of video, give this video a big like. It really does help me out with the algorithm. If you haven't already subscribed, consider subscribing. I'm filming 2 videos today, and today's one is obviously about interest rates, and you'll be watching this on the day that I've recorded it. On Wednesday, there's going to be a really good video about how to buy property and make money on the day you buy it by buying it below market value. And if that wasn't enough, you can get a free one-to-one phone call with me. Just look in the description. I've got absolutely nothing to sell to you. I'm not trying to sell to you at all. I'm just trying to connect with my audience and grow my channel. So until I've got to 10,000 subscribers, absolutely free of charge, one-to-one phone call. So guys, let's talk about what's happened to interest rates, what's going to happen to interest rates, what the bond market thinks is going to happen to interest rates, and that will give us a real good idea of where we sit today. Now, the first thing to say is obviously interest rates have gone up from 0.25 to, I think, peaking at 5.25%. Now, that's a massive increase, and that was because inflation went through the roof. Why did inflation go through the roof? Well, it was simple. We printed loads of money, we handed it out to people, we said stay at home, do not do any work, do not produce. There was a lack of supply of goods and services, there was an increase in circulation of money, and not surprisingly, the prices went up as demand increased and supply was restricted. Basic economics. Everybody saw it coming, or certainly I saw it coming, and most investors that I know saw it coming. However, what we didn't see coming is the length and severity of this interest rate hike. I certainly felt that by 2025, interest rates would really be on a downward spiral, but we have now had some new news. We've got a new budget, we've got a new government. They have raised taxes on working people. I know they say they haven't, but they have. And again, I'm not a politician, so I don't need to lie to you. If they raise employers' national insurance contribution, that is a tax specifically on jobs. There's only 3 things that employers can do to mitigate that. Number 1, raise prices. Number 2, pay you less, i.e. when your pay rise comes around, don't give you one. Or number 3, they can make staff redundant. Those are the 3 maneuvers they have, because we live in a capitalist society where all these businesses don't have these massive margins. Some of them might make big money, but it's not big margins. So we have to accept that it's likely to have an inflationary effect on the economy. That, coupled with the pay rises that have been given to public sector workers and the spending boom in infrastructure, all would signal to us that it's likely that inflation will be higher for longer, and the Bank of England agree, which is why in December there was no rate cut. And furthermore, when we look globally, the Fed is saying that they are likely to only cut interest rates by 0.25 twice next year. Now, why does that matter? Well, that matters because if the Bank of England cut much below what the Fed rate is, the value of the pound weakens, and we are an import nation, which is denoted by dollars. So all your fuel, all your building materials, everything that comes into the UK, generally speaking, denoted in dollars. And because it's denoted in dollars, if the value of the pound drops, then it's inflationary, because we'll be paying more pounds for those same commodities. So the Bank of England's between a rock and a hard place. Yes, it might need to cut interest rates to support the economy, but unless it's done globally the same way it was when the interest rise, then we could have a significant impact on inflation by the fact that the pound would drop in value. Now, my personal thoughts on all of this is it's going to be a delicate balancing act no matter what. I think interest rates are forecast over the next 3 years, even now, to be dropping every single year. I expect that still to be the case. I personally expect interest rates in the UK to be below 4% by the end of 2025. Now that's Bank of England rates, that is not your mortgage rate. You will always be paying 1 or 2% above BOE rate, which is the margin for your mortgage lender. Now I think that is highly likely to happen, and I was far more bullish 3 or 4 months ago when I was recording a video and saying I think it could be down as low as 2.75%, which was the Goldman Sachs report at the time. With the new budget, with the Fed coming out and doing their rhetoric, I believe that interest rates will be higher for longer. Now, what does that mean for us as property investors, or if you're looking to move home or buy a new house? Well, it really is a story of two halves when it comes to interest rates. Now, I personally believe that the North is about to have an absolute boom. And in fact, over the last few years, it has been. It's the South and London that's really being restricted. If you look at central London property, it is down significantly. And it's not about the interest rates for that, it's the scrapping of a non-dom system. It's the fact that we've said that the UK is not welcoming any of these mega rich people. It's as if they've got homes all around the world and they can just go and live wherever they want. It's just that they chose London because we had a fixed tax rate for them. They can just move anywhere, and they are. And this has massively affected central London. Now that resonates out of central London all the way through the capital, and London prices very, very stagnant. Couple that with the North, which is rising at a very fast rate in comparison. I mean, I've seen gains in Sheffield averaging around about 6-7% over the last few years. And that's a really strong capital appreciation because the affordability of those houses, even in a high interest environment, is still there. I mean, we're buying 3-bedroom houses for what? £150,000? If you had a mortgage, if you're a residential buyer and you had a mortgage of £140,000, at 5% or 6%, you're not paying that much. Your mortgage payment's still only going to be about £800-900 a month. It's just not that big. And as an investor, if I'm buying a house for £150,000, I'm putting down £35,000, having a mortgage of £115,000, my interest only charges are only be £500-600 a month. So I can still make a rental profit because people can afford to pay £1,000, £1,200 a month in rent. Now the places that have been massively and severely affected are places down south. London being a prime example where the average yield has dropped to about 4%, held back by affordability. But if you look at any of the real southern cities, I mean, I invest in Didcot, a 4-bedroom house might be worth nearly £500,000. You're still only gonna be able to rent it out for £2,000 a month. That's a yield of less than 5%. And once the mortgage payments and everything are taken into consideration, you're breaking even at best. So let's refocus and go back to what's next for mortgage rates. Well, the bond market would indicate higher for longer. 10-year bond is currently risen to about 4.5%. That was getting down into the 3s not so long ago. But with all these things, this ebbs and flows over time. If the economy weakens and it looks like the Bank of England are going to have to make more cuts, highly likely that will pull back. What I would say is my optimism for 2.75 by the end of 2025 has absolutely gone. The best I believe we can hope for is about 3.75. And even then, my mortgage payments are starting to come down by about a quarter, and I'm starting to feel a little bit richer. So guys, what are your thoughts? How has this interest rate rise affected you? I'd love to know all your thoughts down in the comments. If you put a comment down below, I will reply to every single one, and I will see you on Wednesday for the next video. Cheers, guys.